Welcome to the Daily Insights That Matter. The Finance Bill 2023, which was passed in the Lok Sabha last weekend, has had 64 amendments. Now, in today's episode, we talk about two of those which caught most of our attention. The first one is the amendment that seeks the withdrawal of long-term tax benefits on certain categories of debt mutual funds. And the second one is the proposal to raise the securities transaction tax of the futures and options contracts. Debt mutual funds have been stripped of the long-term tax benefits and would be less tax attractive hereafter. Earlier, debt mutual funds were taxed at 20% along with indexation benefit if held for more than 3 years. Now, this meant that the investors were allowed to adjust their purchase cost for inflation over their holding period, which would ultimately book less capital gains and in turn reduce the effective tax burden. However, now the change is that irrespective of the holding period, debt mutual funds would be taxed as per the highest slab rate applicable for the investor based on his or her ITR filing, making it not so attractive from a tax perspective. If any investor falls in the highest income tax slab, which attracts a tax rate of approximately 30%, they will have to effectively pay 35.8% tax, which includes the surcharge and the cess applicable on their gains without any indexation benefit. Now, this will be applicable for mutual funds with up to 35% equity exposure in the domestic companies or lesser. Additionally, this change would come into effect for all debt mutual funds bought after 1st April 2023. Investors used to flock to debt mutual funds with a longer term horizon as it was an attractive tax avenue compared to FDs and bonds, which are taxed at an individual's tax slab rate. Earlier, a debt mutual fund, depending on the underlying portfolio, would offer a post-tax yield of anywhere around 6 to 7%. Now, this was considered a good tax arbitrage in such funds as FDs with an interest rate of around 8% could only offer post-tax returns of 5%. Now, without tax advantage, bank FDs will offer similar or rather better returns to the debt mutual funds. Despite this, there still are a few tax advantages of investing in debt mutual funds which will tend to continue. For example, the deferral of tax, which means that you don't have to pay the tax till you redeem. The flexibility of withdrawal to the extent of how much you require at any moment available on T+1 basis. The set off and carry forward of the short-term capital gains to any other short-term capital losses elsewhere. The debt funds purchased before 1st April 2023 will continue to get the 20% tax and indexation benefit. The security transaction tax, which was introduced in 2004, is a tax paid on every purchase or sale of certain securities listed on the exchange, such as shares, derivatives, equity-oriented mutual fund units, etc. Now, this tax is set by the central government and is changed periodically through the budget. However, it's not applicable to commodities or currency transactions. Now, in the latest finance bill, the securities transaction tax has been increased by up to 25% on the sale of future and option contracts. Now, this update created confusion amongst traders as the securities transaction tax on the sale of options was hiked to 2,100 rupees on a turnover of rupees 1 crore against an earlier levy of rupees 1,700, thus creating confusion as the securities transaction tax was already hiked from 1,700 rupees to 5,000 rupees in 2016. However, later on, the Finance Ministry issued a clarification stating that the securities transaction tax on the sale of options has been increased to 0.062% from 0.05%, which is a 25% increase. The securities transaction tax on the sale of futures contract also has been increased to 1,250 rupees on a turnover of 1 crore rupees, which is a 25% hike as compared to the rupees 1,000 tax earlier. Now, the proposed increase in the securities transaction tax in the equity derivative segment may not be solely aimed at generating more revenue for the government, but it comes with an inherent aim to discourage excessive trading, as a recent study showed that a large number of individual traders incurred losses in FY 2022. While some analysts anticipate the proposed tax hike to affect the F&O trading volumes and profit margins for traders, others argue that previous tax increases had only a temporary and a minimal impact. In the past, other measures were implemented to discourage retail participation in F&O trading, such as increasing margin requirements and exercising F&O on expiry, but they were not as effective in addressing individual trader risk tolerance. So what does all of this news mean for you? The new amendment would impact the attractiveness of debt funds as an investment option, as the tax burden on the returns may increase. Additionally, even gold mutual fund, international equity mutual funds, fund of funds, and hybrid mutual funds will not have the indexation benefit in the case of long-term capital gains. This will therefore have a direct negative impact on debt mutual funds and investors looking to invest in them as well. Now, the main purpose behind the proposed increase in the securities transaction tax is to discourage excessive trading in the futures and options segment. Nevertheless, the implementation of this regulation seems to be haphazard, and there is still some further clarification required. That being said, it would be beneficial to encourage traders to use hedged positions, which can help minimize losses at the retail level. The rise in the securities transaction tax will therefore have a direct negative impact on you for time being. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.